Welcome traders. Who is in control is the most important question you have to ask yourself when you are trading. Because in trading, it is a constant battle between buyers and sellers. So to know that, you have to understand candlestick patterns. Candlestick patterns are the visual representation of all the activities that buyers and sellers are doing in the market. So in this course, I have given a clear demonstration of all the candlestick patterns, how you can read them, how you can understand them, and how you can apply this candlestick pattern in your trading. And at the end of the course, I have given 3 rules that you can apply in your trading with the candlestick patterns. So make sure you watch the video till the end. And if this is something interesting to you, then smash the like button. Subscribe to the channel if you're new to the channel, and then press the bell notification button so that you don't miss out any of the content I release every day and every week. With that said, let's get into it. Okay guys, so let's start our course, candlestick pattern full course. So first of all, who is this course for? This course is for complete beginner who doesn't have any kind of trading experience. Also, this course is for advanced traders. So both of you will be benefited from this course because this course covers everything about candlestick pattern. Now I want you to watch this video till the end because the important information you will miss if you skip some part of this video. This is very important because price action trading is the most profitable trading used by all the big boys, all the hedge fund banks. They use this price action pattern, this candlestick pattern trading. So hopefully you will enjoy this course. Let's begin. So first of all, basics of candlestick pattern. So what is a candlestick pattern? First of all, what does it mean? Now let's consider that you are in when you are in a primary or you are in a kindergarten school. What they did, they introduced you alphabet, so A B C D. So when you learn this alphabet, then what you did, you use this alphabet in different combination to create different word and sentences. So this candlestick is your alphabet for trading. So you cannot trade a single candlestick, but when you combine with other candlestick and other market condition, then you will get a language of the market. You will understand the language of the market. And if you want to trade profitably, then you have to know the language of the market. So let's begin with a basic candle. So the candlestick is a Japanese name that came from Japan for some reason. We don't need to understand it, but let's begin. What does it mean first? So let's imagine that you wake up early in the morning and started open a chart for the market. Then what you can see is like this, a small dot in the morning when the market opens. So this small dot, when say you are looking at the daily candle, so you see this dot, that means the price started from here when you saw a dot or a small line. And then what happened? The buyers, say for example, the sellers came back to the market. So when people sell, the price falls down, okay, like this, down, straight line. And then after some time, the buyers came back in the market and they started to buy. So when the price, people buy, the price goes up, up. At the end of the day, say the price came here and then again sellers came back to the market and they sold some areas. The price closed here. So how this candle is formed is basically like this. So open and close here. So it formed its body. So this is the body of the candle. And this is called wick. This is also wick. So what happened is the price opened here and then the seller came, pushed the price back here. Buyer came, pushed up here, up to here, and then price closed back in this zone. So this is a candle. This is basically a representation of the order flow in the market. So what the buyers and sellers are doing is a visual representation of these activities a candle is showing to you. So let's now analyze this candle according to the way we have discussed. So what happened? This is open of the session. So a candle can be in different time periods. So we are considering say a daily candle. A candle can be an hourly candle. So an hourly candle represents that in that hour there will be a candle, and the next hour there will be another candle. If it is a daily candle, that means in one day we will see one candle. We will explain this later more clearly. First, so this is the open of the session. The price opened here, and then the seller came to the market, pushed the price down. Then this is the low. So price up came up to here, and then the buyer started to push the price up. So when price came here, why this is green? Because this is the opening of the session, and then when the price gone up, the price is green, 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 green. So when the price came below here, it was red, but when it went up, it became a wood. So came here up to here, this high of the session. So this is the highest price on the day that the buyers brought, and then the seller came back again to the market, pushed the price here. At this point, the market closed. This is the closing price. And after the end of the trading day, this candle is formed. So this is the basic alphabet of the trading that you need to know. So again, I'm repeating, this is the low of the session, this is the opening of the session, this is the close of the session, this is the high of the session. So when you know this, you understand what happened. Now this is a particular time period. It can be a 4-hourly candle, it can be 1-hourly candle, it can be 1-minute candle, or it can be a weekly, monthly candle. So whatever the time frame is the representation of this trading activity happened on this time period. Now let's see how does it look like a seller candle. So this is a different candle. So what happened on the day, on the previous candle, the price opened here and then went up. Now let's assume the next day when the price closed here, next day the price opened in the same place. So what happened after opening? The buyers came again, they pushed the price up to here, and then the seller came back, they pushed the price down, and then they pushed further down at this point, and then the buyer came back again, they pushed the price, and the market closed here. Now the previous one, the market opened here and the price gone up, so it became a green candle. Normally it is a color coded. When price goes, like the buyers are in control, the price goes up, represented by green. When the seller in control, price goes down, represented by red. But you can choose your own color. Normally it's a general color theme for these types of movement. Now the price closed here, so this is the close of the session, this is the low of the session, this is the open of the session, and this is the high of the session. And this is the visual representation for this move of this candle. So I hope that you understood now what a candle is. It's a different time frame, we can use in different time frame, but this is the basic concept of a candle. let's look what types of candle we can see. So now, this is the most important question you always have to ask yourself when you are trading. Remember, always remember this question: who is in control? Remember, because if you know who is in control, that means you will be on that side of this strong group who is in control, and you will be winner all the time. The basic things you have to know. And this candlestick will tell you who is in control, because you need to answer this question before you take a trade. Now, for this candle, who is in control? That's correct. Buyers in control. How do you know? See, the market opened here, and even there is no wick here. So as soon as the market opened, the buyers started to take control. The price gone up to here. This is the high of the session, and then some retracement or seller came. The price closed here. So this green candle represents that. Say the price was here 1.5, and the price closed at 2. The price say went to 2.3, and then the seller came, the price closed at 2. So this represents the buyer was controlled in this trading session. So what about this one? And then say the price closed here, and the next trading session, suddenly all the sellers came back. Even buyer couldn't got any chance. There is no wick. So the strongly price came down to this level, and again some buyers came, and then the price closed here. So this in this trading session, completely seller in control. So this is the first thing you have to understand. When you look at a candle, you have to understand who is in control of that time period, because that will tell you to take the next move. When there is a buyer's control, then you will know that what to do next in combination with other factors that you will consider later. So hopefully you understood this, that who is in control you will understand from the candlestick pattern. Now let's go down to the next one. Now on these types of candle, who is in control? The previous one we have seen that there is a strong body that is telling you who is in control. Now when you see a candle like this, you need to ask this same question: who is in control? So first analyze this one. What types of candle is this? Say, let's see what happened here. So this is the opening, as you know. And then what happened? Buyers came. They pushed the price a little bit up to here. Pardon me. So this is the opening of the session. And then what happened? Seller came back to the market. Strongly, they pushed the price down here. And when they put this price at this level, the bulls came on the market, and they rejected this price. They said, no, we will not let you go down. We will take control. And the buyers aggressively put the price up to the opening of the price, and then even further to this point and close here. Now, in this candle, in this particular candle, who is in control? I will give you 10 seconds. That's right. In this candle, buyers in control. Buyers in control. Why? Because look, the seller came to this point, but at the end of the day, what happened? Buyers pushed the price even higher than where the seller dropped. So this is a sign of strong rejection from this level. When price create a rejection, that means the buyers took control of this candle. And we can name this candle. This is a, we'll learn later how we'll name this. This is basically a hammer candle. So we'll learn later more about this, but for now, it's look like a hammer. So it's with a small body and long wick. It's a hammer. Normally, the definition of a hammer is when the wick is 2 times the body. is called a hammer. And in this candle, so what we have understood is buyers in control. So buyers push the price up. Now let's see this one. What about this one? What happened? The price, the market opened here, and then the buyers came, pushed the price up to here, and then strongly rejected from this level. The seller came back and the closed price back below here. Now, who is in control in this candle? That's correct. Seller is in control, because at the end of the day, the buyers has been rejected from this level and the seller take control. Now this is also a hammer. Remember, this color of the body, when there is a small body like this, for a hammer or a pin bar is not important. The shape and the pattern is the important. This one can be red or green, this one can be red or green, but the same function. So it can be told as a, so based on where it is located, it can be told as shooting star, inverted hammer, hammer. We'll learn it later. But for now, you have to understand that who is in control of a particular candle. So what we have learned from here, there is a long wick, strong rejection. Long wick indicates a strong rejection, and that is a sign of the market sentiment change. So this one here, from seller to buyer to control, this one from buyer to seller to control. Now let's see the next pattern. So the next one is this one. So who is in control on this candle? That you have to know. So this one is a small wick with narrow body. So this candle is basically told as doji. So this one is doji, D-O. So this is a doji candle. So doji means what happened, the price opened here, the buyers came here, pushed the price up, and then the seller came back, pushed this level, put this level, and then again buyers came and closed almost the similar place when the price was open and formed this doji candle. So this, in this candle, represented the buyers and seller had almost the similar battle. So the price is, or no one is in control. That means both has equal control. So this is indecision. The market is in indecision. Neither of this group has won the battle. So this means that doji candle is a very, very important candle. We'll learn later. Now we have learned the basics of the candlestick. Now let's do the summary. So candlestick pattern represents order flow of a particular trading session or a period. So this is the candlestick pattern represents. A candlestick has four components: open, close, low, and high. Also, candlestick represents who was in control on the trading period. So far, are you with me? Hopefully you understood. So basically what we have learned so far is how we will read candlestick and what it means to you. Now let's move on. Now we will learn the combined candlestick, so different time frame. Let's consider this scenario. So let's say that this is a 15 minutes candle. So the price opened here, buyers took it up to the high to this level and then closed back here in the first 15 minutes. So when the market closed here on the first 15 minutes, the next candle start here. Okay. And then what happened? Then the buyers again came to the market, pulled the price up to this level, and then seller aggressively came and pushed the price back here and up, finally closed back here. So this is a 15 minutes chart. When you look at the 15 minutes chart, you see this like that. But what happened when you see on the 30-minute chart or half an hour chart? What do you see? You see this candle. This is very, very important. You need to understand it. Otherwise, it will be very confusing for you when you are looking at the chart. So this, when you look at the 30 minutes or half an hour chart, you see not like this. You see this. So what does it mean? If you see only 30 minutes, what it means that the price, the market opened here, buyers came to this point, pushed the price up to here, and then the seller rejected this price to this level and closed here. So for the 30 minutes candle is basically the open is here, close it here. Okay, this is the rejection. So this is the body for this candle. So on the 30 minute, you will basically see a hammer on this candle. So this is very, very important that you understand this concept of multi-time frame or combined candlestick. Now let's see a real example. Okay, so this chart we will be looking, and let's see the real example. So this is a real chart where you can see this pattern. So let's look at this particular candle. So this, you see this green candle, first 15 minutes opened here and then closed back here. The next candle opened here and then sellers came back, closed back here. So this chart basically a 15 minutes chart, and this is what happened on this two candle on the 15 minutes. Now let's go to the 30 minutes chart. So for the same Australian dollar, US dollar, for the same thing, on the 30 minutes you will see this candle. Look at this one here. Okay, you will see this candle. So the same representation but in a different time frame. So you need to understand it. Look, green candle closed here, the next one closed back below. So finally on the 30 minutes you see basically open here, close here, high and low. So I hope this clears you. So this is what happened when you go to the different time frame. Let's move on. Now let's go to let's see another example. So this is another example on the higher time frame. What do you see that on the hourly time frame, so I draw this box so that you can identify where is the location. So this box is no chart or anything, just it's a separate box. So what we see on the hourly is, see, if we consider this candle first hour, then what we see, the price opened here and then the seller came, take to this point, first open here and then the buyer came, take to this point. From there the seller came up to here and then the price closed back here. So this is the body of the wick candle, this is the low, this is the high. Next one, what happened is the price closed here, the next one opened here again, came to this point, again went up and closed here. So this is became green because this is opening, this is closed here. What happened on the next one? Because it closed here, again opened here. After that the seller came, brought the price here, and then buyers pushed the price back up to here. Again seller came and the closed in this point. So this candle closing here, open here, closing here. And the next one, the same thing happened. Seller came and the close here. So all these four candles, this is 1 hourly chart like this. But if you look at the 4 hourly time frame, the same scenario, what you see is this. Look at this. You will see only this. So that's what very, very important. You need to understand it. On the 4 hourly, you see this. Why? Because look, starting of the hour was here. So this is the opening level of the hour, right? And then price gone up down quite a few times, and then on the final hour, what happened? The closed here, right? This is the closing of this candle. This is the opening of this candle. This is the closing of this candle. They are in the same line. See, they are in the same line. On the other candles, what happened? The price just gone up and down. So on the lower side, the price have come to here. On the higher side, the price have come to here. And that is what we presented on this 4-hourly candle. So the price, where the price opened, closed there. This is the high of the price. This is the low of the price. So that's how you have to read candlestick pattern. I hope this example clears you how you can read multi-time frame candlestick or combined candlestick pattern. Let's move on. Now, major price action pattern or candlestick pattern. So now you have understood how to read candlestick and how you can identify in a different time frame, or how you can read the combined candlestick pattern. Now we'll learn major price action pattern or candlestick pattern. So remember, a single candle will not give you any price indication. It's a letter. Say for example A, or a single B or a C will not tell you anything. It's just an alphabet. When you combine with other alphabet, then it creates a language. Similarly, a single candle will not tell you anything. You need to combine it with other candle, other market structure to create a pattern or language. So that's what we will learn now. The first one is called bullish or bearish engulfing pattern. It's a very, very powerful pattern you need to understand. So first of all, let's learn the bullish engulfer. What is it? So a bullish engulfer is like, so this, consider this is a support. So what is a support? A support is a place where the price came and rejected. We'll learn it more in the future. But for now, consider that this is a support. Say support, consider it like a floor in a house. So this is a support. Consider this candle first, the price opened here, went up here, and then the close back below here. So came here and then closed back here. Okay, this is the low of the candle, this is the high of the candle. So this is the selling candle, this is the support. And on the support, what happened? After closing this candle, what happened? The buyers came strongly, and the sellers tried to put price below and went a little bit lower than this low, and then strongly buyers came to the market and pushed price more than this selling candle. Okay, so the seller was here. Now the buyers went above this zone and create a new higher high. So that is a bullish engulfer. So what is telling a bullish engulfer is the sentiment change. That means when the price came to this support or this floor level, there is a strong buyers in this market at this point, and they took full control. This engulf, this name is came from this candle has engulfed the previous one completely and closed above. So that is telling you the answer of this question, who is in control. So the price was with the seller, the buyers took control from this support. So when you know this, when you understand it, then you know that now at this point you can go long or you can buy, because buyers are in control. So this is a one pattern is called bullish engulfer. So if we just flip this pattern, it becomes a bearish engulfer. So if we consider this resistance, so when it is a floor, say consider this one is a ceiling of a house. So it's a different pattern. So just the other way around. Let's assume that the buyers here is in control. The candle closed in this, the green candle closed here. And then the next one, what happened? The price for the next period, the price opened here. The buyers took control, they create new high, and then what happened? Strongly rejected from the zone, and the seller took full control, create a new higher high, and then the price closed even more than the buyers had in control. So this candle is a bearish engulfer. So when you can see a candle like this on a resistance, it's a strong sign of selling pressure on the market. And at that time, the sellers is in full control, and then you can go for short from this zone. So hopefully you understood this pattern. Let's move on to the next one. Now, a pin bar or a hammer. So as I told you before, you cannot trade these types of pattern as a single candle. You have to combine it with other candle. So how we can trade this pin bar with respect to support and resistance? Let's assume that there is a selling candle. Now you know how this candle is formed, and there is another one, and then the next one, what happened? This is a support. The price came to this level. The seller put the price below, but the buyers strongly rejected and closed even above the support, above this zone. So creating this hammer or pin bar. Okay. And how do you define the pin bar? As I told you, the body, so the width is 2 times than the body, so it is a hammer or pin bar. And at this point, this is a strong sign of buyers in control, and then you can go for long from this zone. The same pattern, just the other way around. So when this happens, there is a buyer, and then the buyers put the price in a new high. Then the seller came strongly rejected from the zone and pushed the price back below the resistance. So this is a strong selling momentum. Okay, I'm creating this pin bar or this hammer pattern. So this is another pattern that we can trade. You will learn more example at the end of this course. So let's move on to the next one. So this is called hanging man or shooting star. They are basically same types of thing, but different combination or different market condition. So this hanging man and shooting star, don't get confused, just pay attention. Okay, I want you to stay focused. We'll learn a lot of examples, so it will be clear. I know that initially it might look confusing to you. So what is the, like this one is a hanging man. So what is the difference with the pin bar? What we see is when this form, the easiest way to remember that I imagine this one is a human, like this is a head, a man is hanging. Okay, a man is hanging here on the resistance. So that's how I normally try to remember. So how do you know this is a hanging man? Is when there is a green bar, it doesn't have to be always green, just an ideal scenario. So the price basically buyers came, and at this point what happened? There is a resistance, and the buyers could not break this resistance. The sellers took in control, and finally the buyers again came, but they could not break this resistance. That means the price closed back below this resistance is a sign of seller in control. Now you might be saying, well, the seller came, at the end of the day, buyers took control. Yes, buyers took control, but they could not break this resistance. If this price break this resistance close above, that is a sign of buyers in control. But this one, this hanging man, is seller in control because they could not break the ceiling. If you want to see more about these types of level, I put a link here on the above. On the right side, you can see another video where I have clearly defined what does it mean. So this you always have to consider in relation to the level. Say for example, if there is a house level, then this is a ceiling, this is a floor. So when the price is here, you need to consider selling, but when the price is here, you need to consider buying. This is another video I have explained clearly. You can watch that one too. So this is the hanging man and the seller is in control. Now let's see this one. So this one is the other way around. The seller created this candle and there is another one selling candle, and then the price came to this support zone. So when the price came to the support zone, what happened? Buyers took control, creating this wick, and then the sellers came back, closed back above this support zone. Now this in this zone we will be considering buying, because the seller could not break this support zone and the price closed just above this support is a representation of buyers in control. So don't get confused, as I told you, just try to understand it. I will give you more example in the coming slides. So, and then another pattern is called morning star and evening star. So they are just a different name of the combination of the candles. So what is a morning star? Is basically the price opened here and the buyers came, creating a new high, and after that what happens? Seller aggressively came, creating a new low, and the price closed finally in this area. So we creating this white candle, and then the next one is creating these types of candle. Okay, so small, wick with a small body. So basically, what happened? The price opened here, a little bit of selling pressure, little bit of buying pressure, and the price closed in the same place. So that is the market is indecision, or when the sellers open the sell entry, they basically close their sell entry in this candle. That means slowly buyers is coming. And the next one, what happened? Is the buyers strongly took control. So open here, low here, closed here, high here, and then closed here. So this is basically the market sentiment change. So the price started to reverse. And after this candle, if it is in a level of area of value, then we'll be able to buy from this zone. So that's a morning star, and the evening star is same but the other way around. So this one, first seller and then indecision and then the buyer. This one first buyer and then the indecision and then the seller. So this one is the other way around. So in this way we can consider selling. So this is the evening star. It's just a name. So let's move on to the next one. Now we have understood all the candlestick patterns, important candlestick pattern you need. Okay, these are the most common and important candlestick price action pattern that you need to create the market. Now you have understood how to read candlestick, how to combine candlestick, and how to understand the different candlestick pattern to find trades. Now we'll learn the rules to apply to this candlestick pattern so that we can trade the market using this candlestick pattern. So there are 3 rules that I have given you, that if you apply these 3 rules, these are proven and tested rule that you can apply in the market. So what is the first rule? The first rule is market structure, trending or sideways. So the first of all, you have to know either this market is trending or sideways. That's you learn from market structure. How do you know? Say when you see a market like this, okay, creating a move and then creating a correction, and then creating a new high, and then there is another correction, and then there is another high, and then there is another correction. So this is basically a trending market. So this is the structure of the market. So this is a high, this is another new high, this is another new high, this is a low, another new low, new lower high, this is the lower high. So this is a market structure telling you that this market is in trend, right? Similarly, for the downtrend, how we will know? So there will be a move to the down. So there will be a few candles that will tell you a move, and then there is a down, and there will be a correction, and then there is another move, and then there is another correction, there is another move, there is another correction. So this is basically a downtrending market. So this is the market structure that you have to know when it is trending. So how do you know either it is trending or not trending? By seeing the market structure. It is very, very important. Now, what is a sideways? So if the market does like this, neither creating new higher high or higher low, just doing like that, going this fashion. So this is a sideways market. This is called the sideways or ranging market. So the first thing you have to, the first rule you need to apply is identifying the market structure. Either it is trending or in a sideways. If you don't know this, then it will be very difficult for you to wake up to trade correctly. Okay. The next rule that you have to apply is finding the area of value. So you have to find out support or resistance or moving average or trend line. So for example, say you found that this market is trending up, okay, like this. You saw that the market is like that. So you saw it is creating a new higher high, okay, and higher low. So that means it is in an uptrend. You found this one. Now the next thing to trade, you need to find the area of value. So area of value means it can be a support or resistance, or it can be a trend line. So this is the trend line. Trend line means where the price is moving along this line. So this, if you see this, the price is here, that means the price is in area of value. But if you see the price is here, it may not be in an area of value unless if there is any level. So this is the area of value. This is the area of value. This is the area of value. So where along the trend line is area of value, or some kind of moving average, or if it is a like this types of market, so this can be an area of value. This is a resistance, okay, because the price touched here, rejected, touched here. So this is the basically area of value. So when you know the market structure, and then you will find the area of value based on these factors. The third rule that you have to know is entry trigger. So when you found the market structure, when you found the area of value, the next thing you have to find out the entry trigger or candlestick pattern that we have learned so far. Okay, so for the market structure and area of value, you can watch the other video that I have linked here, so that you know what is area of value, where you need to be for finding the trading opportunity. After you find the area of value, now entry trigger or candlestick pattern. So you need to find out a candlestick pattern in that area of value, either a pin bar, a shooting star, bullish engulfer, or whatever, morning star, evening star. And then when you see this pattern in the area of value based on the market structure, then you can decide your trade, either you will go long or short. So let's now the real examples when you can apply these rules and what we have learned so far. So example 1, okay, example 1. So example 1, in the real chart we have learned, we have seen so far. So let's consider this scenario. First of all, rule number 1, tell me, I give you 10 seconds. What is the rule number one? Is market structure. That means either you have to find out this market is trending or sideways. Okay, so as we have just recapping the basics, so this, as I told you, these all are candles. See, these all are candles. So individual one candle will not tell you anything. You have to consider the bigger picture based on these candles. So what is the market structure of this chart? Like, what is the rule number one? What you can find on this one? Correct. This is a trending market. So now you found trending, but is it an uptrend or downtrend? By analyzing market structure, you can find it. So let's start from here. This is the move, and then there is a correction, okay? And then there is another move, and then there is another correction. There is another move, correction, move, correction, move, correction, move. So what types of market it is? It is in an uptrend. How do you know? Every time it is creating, say, this low is higher than this low, and this low is higher than this low. This low is higher than this low. Also, in case of higher, a few things sometimes it happens. So they didn't create, but here it has created, and here it has created, here it has created. So this is in a uptrend. So rule number one is in a trend. So you found it is in a uptrend. Okay. So rule number one we found. Now what is the rule number two? The rule number two is area of value, support, resistance. Now look at this particular example, this pin bar. Okay, before we trade this pin bar, we need to satisfy all the rules. So where this pin bar formed, so how do you know this is a pin bar? First, as per the description that we have learned so far, see, there is a small body, long wick, and the wick is 2 times more than its body. So this is a valid pin bar or hammer, whatever you want to say. And then this pin bar formed in an area of value. How do you know that? So if you draw this trend line, okay, so this is in a trend line, first thing. Another thing, look at this level here. So the price came here, creating this support. See, this red candle closed here, and then the green candle rejected from this level. Every time the candle is coming here, rejecting from this level, creating a level of support. So on this support, this pin bar is formed. So this pin bar is in an area of value. So the rule number two to trade this is you found a area of value. Okay, so the rule number two is satisfied, area of value. Now let's go to the rule number three. What is the rule number three? The rule number three is price action pattern. So you found trending market, you found area of value, now the price action pattern. So rule number three is price action pattern. So what is the price action pattern or entry trigger? So what is your entry trigger here? Is this pin bar. Okay, this bar is closed above this support, above this support. So this is the entry trigger, and then you can go long from this. So it's a very profitable trade. So when you apply this three rule, you found the profitable trading opportunity. Okay, is it clear? Let me know if you have any confusion. Let me know in the comment. I will clarify you personally. Okay, make sure you comment below if you have any question. Let's move on to the next example. Now, example number 2 is we learn the bullish and bearish engulfing pattern. So the first rule, as I told you, what we have to consider is market structure. Now tell me, what types of market structure is this? Correct, this is a ranging market. How do you know? Price creating this range. So neither creating a, later it might be trending, but for this zone, it is in a range. Or if you consider this move only, it is an uptrend. This move only, it is a downtrend, but overall picture, it is a ranging market creating a resistance and a support. So how do you consider this? Let's find first area of value. First, consider this one, okay? The first one is we found the market structure is ranging. The second rule is area of value. So this, if we see this zone here, this is a resistance zone. How do you know? So the price, basically it's not a line, it's a zone. So this zone is, look here, this is a resistance here, there is a resistance here. The price rejected from this two zone, creating a level of resistance, and then the price came here, again went back there, creating another touch, and then strongly rejected. Now how, so this zone is this, from this zone, this red candle is created. This red candle basically a bearish engulfer. How do you know? See, this candle basically engulfed completely the previous one. The seller, the first look at this candle, the price closed here, and then the next one, the seller strongly pushed the price back up to this point and closed back here. So this is a bearish engulfer from the level of resistance. The price came here, completely engulfed the previous one, is a sign that the seller is in full control of the market. Okay, so that's a bearish engulfer as we have learned so far. Okay, so let's see this example. Okay, this is the bullish engulfer example. So let's apply the rules, same rules here. For this one, this is a level of support. How we know the level of support? See, the price created a resistance here, later broke and acted as a support in this zone, and also has a support in this zone. The price came here with this red candle and then rejected. The buyers strongly took control, creating this strong green candle. Now, when it has created this green candle, then we can think of trading, but we need to again apply all the rules. The first one, we need to understand the market structure. Okay, so this is a sideways, as we already explained, but if you consider this move, this can be a trending, but as we know that the price came to this level of area of value and then rejected. So the first rule that we will be applying here is, what is the first rule? Market structure that you have known. Second rule, area of value. Both is being applied. The third rule is price action pattern or entry trigger. That's what we have learned. So this is a bullish engulfer on the area of value, the supporting the market structure. So we can go for long after this candle for this move to the upside. So let's move on to the next example. Okay, so third example is about the shooting star. This is a very, very profitable price action pattern. So shooting star and hanging man. So first of all, let's see this example here. So this candle, you see this candle, this is a perfect example of shooting star. Okay, so this, first of all, let's see this market structure. Rule number one, market structure. What is the market structure from this move? Let's correct. It's clearly this is an uptrend, creating a higher high and lower high. Let's see this move, creating this high and then this correction, creating a new higher high and then the lower high and then the new higher high. Every time it is creating a new higher high. So rule number one, satisfied, it is in a applied, it is in a uptrending market. Rule number two is find the area value. So this is a trend line. Okay, so in one sense it is an area value. Also this is a level here. Okay, so this is the area value for this candle. So this candle is formed we learned the market structure and we found the area of value for this candle. Now we can trade this price action pattern. So this is a shooting star. How do you know it's a shooting star? Is because this candle has an opposite direction wick that we have learned so far. If you still not understand, go back to the lesson and see what is a shooting star. And then this is formed, this candle is formed in an area of value. So it couldn't break the support but closed above the support. So we can trade this as a shooting star pattern. This start rule is an entry trigger is a shooting star, and go for long with a stop loss below this low, and it's a very high risk to reward ratio trade. Alright, so far with me? Alright, cool. Now let's see, this one is a hanging man. So this is just opposite. Okay, this hanging man is formed. So first of all, what is the first rule? Market structure. This is a ranging market. Okay, if you see the bigger picture, it might be trending, but for this zone it is ranging. So as it is ranging, then let's find the area of value. So this is a one touch resistance, resistance, resistance. Okay, so first the price came here, rejected, creating a level of resistance, again came back here, again rejected, creating another level of resistance. When the price came here, we can watch the price action for further rejection, because since it has rejected quite a few times, there is a chance that it will be rejected again. And that is what happened. What happened? The price came here to this zone, creating this hanging man. As I told you, how do you remember hanging man? Consider this is a head, hands, okay, two legs, okay. So this is a hanging man, and shooting star is just the other way around. So when you see this hanging man, that means you found the third rule to be applied for this trade, and then you can go for short from the zone with a, so it's a very tight trade, but you can have a very good risk to reward. If you use stop losses above this zone for entry here, it could be a 1 to 4 or 5 trade, even with this small movement, if you know how to apply this shooting star and hanging man in the real chart. Okay, so let's see more examples. Okay, so let's see example number 4. Okay, in the example number 4, we will learn how we can trade the evening star and morning star. So as we said, the evening star, morning star is like there will be a couple of candles, but for this one, what we see is the price, this green candle has moved, and then creating this is like a plus like candle, which is a small, with a small body, and then from here, what happened? The price fall. Okay, so creating this evening star. So in this evening star, how will be trading? This is a level of resistance. So we can't see left, but there is a level that is creating this level of resistance, and from this level, from this zone, you can go for short. Your stop loss will be above this low. So what are the rules that we are applying in this one? So this is a, so far we can see that this is a sideways market. There is other candle that you can't see, so creating this ranging market. And after the in this ranging market, this is the area of value or resistance, creating this evening star. Our stop loss will be above, and then our take profit will be this move to the downside. So rule number 1, market structure we have found. Rule number 2 is area of value we have found. Rule number 3, the price action patterns, evening star. For the morning star is same. So what about first rule here? So this one was sideways. What about this one? Correct. This one is a uptrending market, because see, every time it is creating a new higher high and lower high. So we found a trending market, and the second is finding area of value. So this level, see this candle you are thinking about. So this level is basically area of value. Why? This candle, this this zone, the price has been rejected quite a few times, and also this is a swing low for this move, for this trend, creating a new. So this basically this zone is just a bit above this zone. So this candle is rejected from this previous swing low. So this is the area of value. This is the area of value, and in this area of value, so what we can do, we can see this morning star, red candle, and then the previous one is Doji indecision, and then the next one is green. So we can go for long from this zone, and our stop loss will be below, and then slowly price will move up. That's what we expect. So we have learned this example 4 as well. Let's move on. Now we have learned all the examples that we need to understand this bisection pattern. Now we are at the end of the course. See, I have given everything you need to understand the bisection pattern, all the rules that you need to apply, all the technique that you need to read the market structure. I hope that you enjoyed this course. If you have any question, just let me know in the comment, and also let me know what next want me to cover for you, what types of course or technique or strategy you want to learn. Just let me know in the comment. I will do a video for you. I hope that you understood everything, and I hope you enjoyed it. Thank you for watching. Don't forget to subscribe for more content in the future. Thank you.